To build a property investing business, you need two key things. You need to be able to get good quality deals and lots of cash in order to be able to purchase those deals. In this video, I want to share with you how I've used other people's money to be able to build a property business so that you can do the same too. If you're watching my videos for the first time, my name is Saj Hussain, and on this channel I share with you my 15 years of property investing experience to ultimately help you get further faster in your property investing journey. When it comes to using other people's money, firstly we need to understand the structure in terms of how is it we can do that. And there's really two key forms. There's either a loan or a joint venture. On a loan, it's essentially debt that you have, and if it's a joint venture, it's equity that you're offering. So let's look at those in much more detail. When it comes to loans, most people understand this concept, whether they're the lender or the borrower. Let's say, for example, you're going to borrow £100,000 over a period of 12 months and you have a return of £6,000. So essentially 6% is what you're paying on that £100,000 loan. Now, maybe you pay the interest at the end, so £106,000 at the end with the capital and interest, or it may be you're paying the interest each month at say £500 a month, over a year comes to £6,000, and you return the capital at the end of the £100,000. Now, either way, what you're doing is having a fixed amount of money for a fixed period of time with a fixed return, and these are the key components of a loan. Now the thing is, if you're borrowing the money, regardless of the outcome of the project, whether it takes longer, it costs more, you make more profit, or whatever it might be, what you've agreed with your lender is that this is what the outcome is going to be: a fixed amount of money, fixed period of time, and fixed return. And that's the key distinction in a loan. When it comes to a joint venture, the key thing here is you're sharing the risk and the reward, and none of the things are essentially fixed. What that means is the outcome is not certain. For instance, if you have £100,000 from an investor and they're coming into a project with you, and let's say you estimate the return is going to be 10%, you can't guarantee that 10%. If you did, then essentially it's a loan, you're fixing the return. But what happens is it depends on the outcome of the project and how that project turns out, and they might have a percentage of that outcome. So essentially the return may be estimated at 10%, but there's no guarantee it will be that. It may be way more, it could be way less. But the investor who's putting the money into the project, they are sharing the reward with you if it comes out way better than expected, or on the other side, on the flip side, they're also sharing the risk with you. So that means if it doesn't quite turn out to be the way you want it to be, they're also sharing the downside. They're really the key differentiators between a loan and a joint venture. On a joint venture, you're sharing the risk and the reward, no certainty of outcome, whereas on a loan, the returns are fixed, the amount is fixed, and the period is fixed as well. The other important thing to mention about joint ventures is where you're sharing the risk and reward, the FCA, the Financial Conduct Authority, they have some guidance in terms of how you should be going about doing this. And in essence, what they say, you really shouldn't be marketing for money in this particular way, because it's really about only marketing to people that are high net worth individuals or sophisticated investors. And they have some guidance in a document called PS 13/3. Now, this is a document that came out several years ago. It's not just for people in the property sector, it's just generally across the board when it comes to raising money. This is why often some people find it easier to raise money via loans, because the same rules don't apply in terms of marketing for a loan for your property investment business. Now you will see some people marketing for investment on their property projects, and they'll be mixing up loans and joint ventures, and the language will be wrong. They'll be offering you fixed returns on a joint venture and a profit share, and that's really because they don't really necessarily understand and they're not aware. The key thing is, if you're investing money with somebody, or you're borrowing money, or you're taking on investment, that you understand how it should be done correctly, then really it's down to you to make sure you're following those guidelines. And I wouldn't really worry about what everybody else is doing, because to be quite frank, many people don't really understand this and they get it wrong. To help you, let me explain how I do this and how I use these structures, just to give you some context. But just before I do that, if you're enjoying this content, then make sure you click on that like button, subscribe to the channel as well, and make sure you enable the notification bell, and that way YouTube will let you know when these videos are being released, so you're not missing out on any of this great content. My preference is when we're purchasing property to pay for it in cash. So where do we get this endless amounts of cash from to buy this property? Well, this is what we're talking about. We use other people's money, and that's why we'll be able to buy so many properties and keep growing the property business. Effectively, cash means that we can get transactions done a lot quicker, we get the best deals as well, and that's really what it's about. So how do we structure these deals when we're borrowing money from other people, when we structure them as loans? Well, there's no standard way that we use. However, we have this concept called layers, and this is what I want to share with you now. This is our methodology in terms of when we're borrowing money for projects, how we structure them, how we set the returns. When it comes to returns, we'll typically pay between 6 to 16% as an annualized return on the money that we're borrowing for that particular project. So why does it vary so much, and why is it that it's not a set rate? It's because the way we set it up. So let me explain a little bit more about how we tend to do that. So when it comes to a purchase, let's say it's a purchase where we need £200,000. Let's say it's £150,000 to purchase the property and another £50,000 to renovate that property. So a total of £200,000 is required. And let's say we were going to sell it on, it's a flip project and it's £50,000 of profit in that. So let's break down those numbers. Ordinarily, if we're purchasing a property at £150,000, you're either using a bridging loan or maybe a mortgage. That'll give you about 75% of the purchase price. However, what we will do, we'll borrow the money from an investor and we'll pay 6% on that first chunk of cash. So we call it the first layer. So approximately £110,000 in this example is used where we're borrowing the money, we're paying 6% a year, which is £6,600 interest over a year. So we'll give it a year as an example just to help explain how this works. The remaining money we need to still do the purchase, which is the other £40,000, i.e. roughly 25%, forms the second layer of the deal. So that comes from an investor. Now this rate will be at 9% as an annualized return. So that means £3,600 interest we're paying for layer 2 of the money. Now that's all the equity used, i.e. the £150,000 as the purchase price, both for the first stage, which is secured by first charge, second stage, which is secured either by second charge or maybe even a restriction. The third layer that's required to do the renovation, the £50,000 that's required there, we pay 12% for that, so that's £6,000 over the year. And what that means is then we've got the total of £150,000 for the purchase plus the renovation, a total of £200,000, all borrowed from other people at different rates depending on how the deal is structured. Now this way of doing it means that actually we get the rather than paying a fixed rate for the whole thing, we might have 2 or 3 people maybe invest in a project, and generally my preference is to minimize the number of people in a deal. I don't like the idea of having lots of different investors together. It causes lots of complications. You make it simple by having a couple of investors, but you can structure the rate in a slightly different way. As I said, there's no standard. This is just an example of how, for example, how we would use the layering concept of money. So in this particular example, let's say it ran for a year. That means we're paying a total of £16,200 interest. That's a great return for the investors that park their money in that particular deal. And what's in it for us? Well, actually, if we were making £50,000 profit, that means we're still making £33,800 that didn't exist before. And so by leveraging other people's money, using other people's money, not only we're able to pay them a great return, it means that we're ending up with a great profit as well. And that's why we can set it at different rates depending on how that money is used, whether it's used for the first chunk of the purchase, it's used as a top-up purchase, it's used for the renovation as well. And so thinking about how that money is used and what's the alternative. So for example, you get a mortgage or a bridging loan, what rate would you be paying for that? So you've got a comparison, a guide in terms of how you're structuring your deals. Let's now talk about if you set it up as a joint venture, how that varies and how we do that and how that's very different to using standard loans. With joint ventures, I see these as very different to loans. The primary difference being how long we get involved with each other for. So previously when we were talking about loans, they're typically for about a year, often even less in terms of how long we're working on a particular project. When it comes to joint ventures, these are long-term arrangements. Sometimes they're like a marriage, right? Well, I mean, I have some joint venture arrangements where they're like 10 years. And look, some marriages don't last 10 years. So it's really important that you think about who it is that's going to become a long-term business partner with you when it comes to joint ventures. So let's look at an example of how we would structure joint ventures and how we do these deals. And again, just like with loans, there is really no set standard, but I'll give you an example to help you give you some context or get you thinking about how you might want to do this too with regards to your deals and how it is that you're finding deals and how you're structuring them. Let's say the investor brings £700,000 to get involved with us in joint ventures. So it may be that we look at purchasing, say, 2 properties a year at roughly £250,000 each. We'll add about £100,000 of works that will get done to them, so we'll have a spend of £350,000. So the £700,000 is split over 2 properties where we spent about £350,000. And typically with these type of properties and what the sort of projects we've been doing, we'll get an uplift of close to £100,000. So what that means is the end value will be in the region of £450,000 or more on these type of properties. And these particularly we tend to do on high-end quality HMOs in and around Birmingham. That's our kind of core bread and butter model, if you like. And because we've done this many times, we know how we can get those kind of results. And of course, with joint ventures, they're showing the risk and the reward, the upside, the downside. And so my job is to mitigate and minimize that risk. And when it comes to other people's money, you know, I'm very obsessive about how we manage that, because look, I've been doing this for a long time, working with other people, raising money from other people, doing the project, building the business this way, and I still want to be doing this in many years to come. So I'm very cautious in terms of our approach, and this is a thing that's really key when you're looking at other people's money, is how you're managing and how you're looking after that money. So in this instance here, what we're able to do, we're refinancing those projects, and we're probably getting back around 75% of the value. So we're leaving a little bit of money in each deal. So we recycle the cash, we move on to another project. So let's say over a period of 3 years, we've purchased 2 properties a year. So that's 6 properties that's purchased over the 3 years. And at each stage, we left a little bit of money in because we haven't been able to pull all the money out. So at the end of it, we've probably got about £100,000 of the investor money still tied up, and £600,000 of that has gone back to the investor. You might be wondering right now, why would an investor bring £700,000 to the table to work with some project? What's in it for them? Well, in this example, what we're able to do is generate a profit each month from each house around £1,000. It tends to be a minimum of £1,000, and often it's much higher. So that means over the 6 houses, that's £6,000 a monthly income that's been generated, which is £72,000 a year. Now, the way we structure these deals, we tend to split the equity and the rental profit in half. So we have 50% each. So from that £72,000 of rental profit we're making, we're effectively sharing that in half. So the investor generating £36,000 return for them. Remember, at this stage, they've only got £100,000 approximately of their money, or probably even less, left in this particular arrangement that we have, this particular joint venture arrangement. So that means they're getting 36% return on the capital that they've got employed in the property. Then, of course, there's the equity we've created. So in this example of the 6 properties, there's £675,000 of equity that's there, and we own that half each. Although that's a paper profit right now, we don't extract that right now, but that's also owned by the investor. So that means we've created about £250,000 equity for them over this period of time, as well as this amazing return on investment that they're getting on the capital that's still left in the deal. And remember, they've got about £600,000 back. So it's a fantastic win-win deal. It's a great deal for the investor in terms of building a long-term portfolio. Now, this kind of model is not going to work for everybody, but I'm just giving an example of how we structure it. So effectively, the way I say is, look, I use my time, skill and experience. I find these fantastic property investment opportunities, and then I partner with people who've got the funds so that we can share the rewards and the profit, whether that's done as a loan we talked about earlier on, whether it's done as a joint venture like this. Now, when it comes to these joint ventures, I don't do lots and lots of these joint ventures. At the end of the day, we're not a production line. We can't just churn these things out. They take a lot of effort in terms of finding and the skill in converting and making them work, producing the returns and getting those very good valuations at the end of it to get sufficient uplifting value. So we can't churn lots of these out, so we tend to do a very small number of these. This is how I tend to structure deals when I'm using other people's money. So it's either a loan we're given a really good return on, or we're partnering with them for long-term profit share. And sometimes people, maybe for religious reasons, they don't want to get interest on their money, so they prefer to do a profit share. And there's other ways we can structure deals as well, but these tend to be the primary 2 ways to do this. You may be wondering right now, where do these investors get all this cash from? Where does the money actually come from? Well, having been working with investors and funded for many, many years, I've found in my experience there's a few key places that this money actually comes from. So sometimes it might be savings, particularly those that are very high earners. They might be saving a lot of money. Other times it might be they've got business profits that they've got retained in the business and they're using those. It may even be they've sold some kind of investments or other assets that they have, maybe even a property that they've sold. So it's not uncommon for somebody, for example, down in the southeast to sell a property that's got significant capital growth in it, that's had that capital growth, so a lot of equity in it because the price have gone up so much and they've just now reinvesting that money. Also, there's pension money or SAS money, and this is what many people don't really think about, but this is an easy way to access quite significant amounts of money. But sometimes probably people don't even realize that they have. This is where, when people are normally investing with me, this is often where this money comes from. So when you're looking to raise money, think about where that money might be coming from, who might have access to that kind of money. And if you're interested in learning more about investing with me, either as a lender or a partner in projects, then we'll put a link in the description below for you to have a look at, and that'll tell you a little bit more about working with me. And we can, if you're interested, we can arrange to have a chat and discuss how that could work. At any one moment in time, there's a number of different types of projects I might be doing. So for example, it might be buying, renovating and selling those properties. It might be with converting properties to high-end HMOs that we want to keep for the long term. It may be converting commercial buildings for residential use. It may even be building new properties out of the ground, because there's lots of different strategies that we use at any one moment in time. It's really where we can get the best return on the investment that we have. And so if you're interested in getting involved and you've got at least £50,000 to invest, then make sure you check that link below, and then we'll arrange to have a chat and help you get a fantastic return on your money. We've talked about the structure in terms of how to structure other people's money, and if you've enjoyed this content, you are absolutely going to love what I've got lined up next for you, and that's how to find the money and how to use other people's money. So this video I've got lined up next for you, make sure you watch that next. But just before you go, make sure you click on my face so you subscribe to the channel as well. That way you don't miss any of these videos when they're released.